This video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Alright, hello and welcome to Camel Finance. I'm your boy Camel and this is the weekend's deep dive. On the weekend, we like to come back and re-examine the base case hypothesis of the channel, check to see if any invalidations have occurred, and if not, then we can say, roughly speaking, things are still going according to plan, according to expectations. I've got a little bit of new data today. I'm again going to point at a couple of things and say no changes there. And most importantly, after a couple of weeks of kind of sitting back and letting the market decide what it wants to do, the market has now made its decision, right? It's now revealed its direction to us. And we can say with a lot more confidence than we've had over the past couple of weeks, we've got a trend in place. And I will therefore show you how we're going to set yet again another third and final blow off top angle. We've done this, I think, at least 2, if not 3 times before during this bull run. The reason we do this is, as you'll see in a minute, it enables us to set an area on the chart to take profit into local tops. And in case that local top should also happen to be a major top, then it enables us to get out of the way and sidestep the drawdowns, wait for the market to spill. And then, of course, once the market has proven itself, got some momentum behind it, then we can hop back in once more, as the OGs of this channel, or the long-time followers, will have seen me do a bunch of times already. So I'm going to show you that. As ever, we're going to run through this thing from the top down. And of course, if you're new here and you want to follow along, then make sure you hit that subscribe button and tune in on the weekend. So from the top, the base case for the stock market was at the lows. We were too bearish. We'd have a big blow off top to all-time highs and then come tumbling down in a global bear market and recession. And here's the key part. This would actually be the third time that the US experiences deflation for a short period. I know there's going to be 1 or 2 smart Alex that know their market history and say, actually, the US has already seen deflation 3 times, not 2. But if we're honest, that slip for the third time in its history was essentially just a wick that immediately reversed. So I'm calling for this to be the third significant time that we have seen deflation in the US. This is quite a contested point. We'll get to the inflation data in a minute, but I do still maintain that we are probably going to see the US slip into deflation for up to 2 or 3 months. Fast forward to today, and again, we've had these 3 blow off top angles, right? We use the third increasing angle of steepness as a sell signal. And as I said right at the start of the video, this is not the first time you've seen me do this, okay? The long-time viewers of the channel will know that we've done it once here, okay? We then redrew this angle in here, and I have a sneaky suspicion, although don't quote me on this because my memory's not super clear, but I have a sneaky suspicion we did it somewhere in here as well. And each time what we do is, once we've seen a breakdown, okay, we use this to sidestep the drawdown, wait for momentum to return, wait for technical repair, and then once the market has proved what it wants to do, we can set another third and final blow off top angle. I think we also must have done it in here. Oh, here it is. Okay, so we did the first one here, then we did the second one here before the yen carry trade unwind, and then again we set it for a third time. Okay, that's right. I've reminded myself what happened. Got the breakdown, got out the way before Christmas, did a bunch of dip buying during the spill, and now I think it may just be time to set yet another third and final blow off top angle. Now, for anyone that is new here, I like to use the daily cycle lows to set the angle, which we won't see for a little while longer. So expect some kind of push higher and a roll over into a daily cycle low, and then I will set the blow off top angle from there. In the more short to medium term, as I said, we have at least had the market prove to us what it wants to do here. Okay, we had these 2 scenarios. Okay, I was saying if we fail that daily cycle low, then we will have to entertain bearish scenarios and start to only expect lower lows. And if the market wants to push higher, then that was the reason for being positioned long out of this daily cycle low, as you can see here. So long and strong, happy days for now at least. I think we can at this point certainly scratch this failed daily cycle idea off of the table. That low is still in validation until we find the next daily cycle low, by the way. And like I said, once we find that daily cycle low, expect me to set another trendline support angle, which we will use as a tell for when the market is breaking down and how to exit the trades, lock in the profit, and sidestep any future volatility and downside should it occur. For Bitcoin, we've been working on the idea that we would find a weekly cycle low and then come swinging out of there approximately to around 150k, just like all the prior weekly cycles have yielded approximately a double off the lows. And of course, fast forward to today, we are well on our way. I know we're getting a little bit of chop and sideways in here. To me, it reminds me of this kind of congestion period we had back here, kind of traded sideways for a few weeks, and then we began the next push up. So I don't think this is invalidated just yet. I still think this is very much in play. So in terms of Bitcoin, I'm happy to say long and strong there as well. As I said at the start, I'm still calling for continuation of disinflation followed by a short period of asset price deflation. And this is for the very simple reason that anything you do to M2, okay, shows up in the CPI with a lag. Since we had this huge whiplash effect off the back of the C19 era, I have long been making the case we would see the top in inflation, we would see a disinflationary trend, and ultimately slip into deflation for a short period, okay? And when we look at the trueflation data, again, I think, as I often say, analysts and traders have a little bit of a problem, especially the inexperienced ones, of zooming all the way in on the data set and looking at things like this and saying, well, there you go, sticky inflation, resumption of inflation, et al. But just like back here, when a lot of people were telling me that it was wrong to be calling for inflation to continue to come off, and I was saying, no, I believe this is a counter trend wobble. We need to give the market the space to relieve itself here and then continue to roll over. And sure enough, it did, okay? No hard invalidation was triggered. We got a big spill to new lower lows. And I am still sitting here maintaining that whilst investors are going to zoom in at the hard right edge here and call this resumption of inflation, or the bottom is in for inflation, I still maintain that this is nothing more than a counter trend wobble that will ultimately resolve to new lows and a continuation of disinflation. So yes, some counter trend wobbles and bounces along the way are expected, but we know from the last CPI prints and the last PPI prints, the inflation data is moving in the right direction. Like I said, we expect some wobbles short term. That's absolutely normal. Nothing moves in straight lines, not stocks, not commodities, and certainly not macro data sets. The most recent data set this week was PCE inflation, which did come in slightly hotter than expected. Kind of makes sense since we're in the middle of this kind of short-term macro data set wobble, as I said. But as you can see right here, especially if you pause your screen and take a good look, it's not coming in scorching hot, right? It's just marginally above, which again is expected over the next few prints until we can resolve that counter trend wobble. And of course, the next part of this primary hypothesis of mine is that once we eventually enter a recession, there will be labour market deterioration, and that if we continue to track that labour market deterioration, we should be able to use it to start to signal when things are going to start to get worse and worse. And so shout out to Marco here. Marco doing a lot of the heavy lifting for me this week. We know at the start of the month, we got labour market data in line with expectations, roughly speaking. And again, this data set continues to be complex, right? Non-farm payrolls came in at 139k. So seems pretty good, right? Well, actually, no, and that's because negative revisions persist. In the past 16 months, non-farm payroll has been revised down by a total of nearly 800k, or approximately 50k a month. If we apply the average monthly negative revision, the May number drops to just 89k added. So still looks okay-ish, according to Marco and according to me. I don't think we're at that stage where we're going to see the labour market truly deteriorate rapidly like it does during recessionary periods, but we are teetering on the edge of that, as I continue to show you every time we do one of these weekends deep dives. However, it gets a little worse here because, as Marco points out, it doesn't include the likely negative annual revisions. Again, telling us that under the hood, things are probably a little bit worse than they're letting on. This also means annual revisions could be in the region of around minus 900k or around 76k on average per month. And if we assume the same persists after March of 25, the May figure drops to only 13k, which of course is barely positive and dangerously close to contraction. So very, very slowly note the trend here, okay? Nothing too alarming. There hasn't been anything too alarming for a long time. But again, notice the trend. Every week we come here and we take a look at any new data updates that have been released. We have a little bit more of a deeper dive into some of this data as it becomes available. And if we ask ourselves honestly, is this data gradually improving? Is it staying the same, or is it gradually getting worse and worse and worse? The answer is, objectively speaking, it is gradually getting worse and worse and worse every week. Again, not at any kind of explosive accelerative rate that would let us know that the economy is collapsing and a recession is finally here and everyone's going to die. Nothing like that. But it is, like I said, slowly but surely deteriorating week in, week out. And speaking of recession, household employment was down massively in May, showing nearly a 700k loss. Okay, take a look at this, hard right edge. This is not nothing. And the unemployment rate, of course, has ticked up only marginally. It's still kind of sitting around there, but this is the highest rate currently in 43 months. So again, not exploding, not causing any need for panic or dumping the whole portfolio, but equally, this is not staying the same. It is not improving either. Moreover, the unemployment rate went up whilst participation rate fell, and typically that doesn't happen when the economy is doing fine. With unchanged participation rate, the unemployment rate would actually be 4.55%. Again, speaks to gradual deterioration. So to sum up, May's employment may look good at first, but the downward revision make it much weaker than it seems. Again, you'll notice that theme on this channel. The unemployment rate went up to the highest level in 43 months, and that happened with falling participation rate, suggesting more weakness under the hood, again, that they're letting on. It seems to me like if everything was actually okay, they wouldn't feel compelled to continuously revise and mess with this data. And as I often come back and track on the weekend's deep dive, I like to look at U6 because when this thing spikes, it tends to be synonymous with recessions, okay? And so every week I say we get a lead-in phase before acceleration, and those are what usually mark the recession. Now at the hard right edge, this is clearly a lead-in phase. This chart is a couple of months old. This line right here is 8%, and I can show you what it looks like so far, okay? This is what it looks like so far. No new lower lows, certainly not improving, and we're just about 1 or 2 weekends deep dives away from getting the next print. It's forecast to be in line with a prior print at about 7.8%, so again, going back here, you can see that this still has all the characteristics, symptoms and hallmarks of a lead-in before acceleration. I would love to see this thing roll over, don't get me wrong. I would love to be able to come back here and say, okay, happy days, okay, labour market is improving. But again, that's not what we see under the hood. And thus I still maintain that the Fed is behind the curve. The Fed is saying silly things that convince people that are uneducated, such as tariffs are inflationary. And then of course, as I said earlier, people are tending to zoom in at the hard right edge of the chart and not look at the major trend and the bigger context here. But I still maintain the Fed is behind the curve. And instead of me harp on about this, I actually found a very nice thread again from Marco here. So I thought I'd quickly go through this so that you can hear it from somebody else, okay? The Fed is stuck at 4.3%, while CPI is virtually the lowest in more than 4 years, and the labour market is pointing to a recession. Again, very, very slowly, but undeniably heading that way. So here's why the Fed could miss this entirely and end up having to start panic cutting on the way down. Number one, the Fed is ignoring the jobs, as we already went through, and we can see there's a bunch of revisions, again, as we already went through. And as I showed you earlier, okay, the household employment monthly change is also not good. And we know the unemployment rate is kind of sat there around these levels that could very quickly morph into acceleration to the upside, synonymous with recessions. Now, at the same time, the Fed keeps talking about inflationary tariffs. CPI of 2.35% year over year is too low for their 2% target, but the common mistake is to think the Fed targets 2% CPI, which it actually does not. Instead, they're targeting 2% PCE. Historically, CPI trades around half a percentage point above PCE, meaning a CPI of about 2.5% year over year is consistent with the Fed's 2% inflation target. By the time we get down to 2% CPI, it would actually be too low for the Fed, because it would be down at around 1.6% PCE. And again, as I said, everyone likes to zoom in at the hard right edge of the inflation chart and say, here's the resumption of inflation. But does this look to you like that is even a sensible idea to entertain at this stage? It certainly doesn't to me. And as you can see, here's the difference between headline CPIs and PCEs year over year, okay? Nothing to be concerned about here. There is no inflation anymore. They have successfully been restrictive enough to tame inflation. So the Fed thinks the cuts will work in about 6 to 12 months. But there's a 3 to 3.5 year lag, which means if you delay it now, the damage is already done. Again, it speaks to what I've been saying over and over again, that the Fed is overly restrictive and will end up having to panic cut. Also, as a nod to those of you that like the controlled demolition idea, is this really incompetence? Or do you think they know what they're doing, right? Seems to me like they are orchestrating this controlled demolition with precision here. Meanwhile, the 10-year yield at 4.3% could climb if the Fed waits. Equities and housing market risk a very hard fall, and the lag is the killer here. I know we had the whole tariff tantrum and a bond capitulation, but I actually think the worst of that is behind us now, and I think as the bond market in aggregate starts to price in what's being presented here, it is going to bid bonds and the yields are going to come off strongly. And of course, there's a reason they call this thing the chart of truth. The moment the 10-year yield comes off, the Fed is going to be forced to start to cut rates. However, of course, the big question is it going to be too little too late? On top of all this, building permits and housing starts are already at the weakest since the 2020 recession. And at the same time, builder sentiment is also in the doldrums. Here's building permits and housing start, okay? Look at this. Does this look like something that is gradually improving over time, or does this look like something that is gradually deteriorating over time? Same for the housing market index. We also know the ECB has been cutting rates, okay? They're back down to about 2%. And at the same time, the Fed has only made 4 cuts from September to December of 24 and has been on hold ever since. The best thing is that inflation in the US, if measured the same way as in the Eurozone, has been lower than Europe virtually the entire time, okay? Which again speaks to the idea that they are extremely far behind the curve. The Fed's lag is actually your signal. There will be a time to go defensive, just not yet, hence the long positions across the board. But as you can probably see, and as I know I've said a bunch of times already, this week in, week out is, objectively speaking, slowly but surely deteriorating. This whole thesis of mine is slowly but surely playing out I would love to come back here and say, oh, good news, guys, the labour market's fixed itself. Oh, good news, guys, the Fed's started to cut and be more accommodative relative to its inflation situation. But the reality is, whilst it's nice to be long and strong and making some money, we are indeed heading for a recession. And I think there's a very good chance we're already in one. Just keep in mind the NBER, the National Bureau of Economic Research, who are officially in charge of declaring recessions, normally do so after the fact. Which means I actually think when they go back here, they're going to end up painting a grey bar sometime around the middle of this year and then extrapolating it out 12 months into the future. If we're not there already, I certainly think we're going to be there soon. Does that mean the market has to crash immediately? No, of course not. Okay, hence the long positions, hence the cautious optimism here. But under the hood, it is extremely silly to say everything's fine and the economy is not slipping away into a recession day by day, week by week. So the last few things I want to point out before we get to some charts and positions is the Sahm recession rule. There's still no update on this. I still make the case that this is potentially lead in before acceleration as well, just like the prior times we saw recessionary periods and just like that U6 chart. I would love nothing more once we get an update to see this thing print a lower low, and then we could perhaps start to entertain that this is not lead in before acceleration and instead is just a little wobble that's going to resolve lower, in which case, happy days, okay? That would be the first sign of repair in all of these metrics that we track. So far though, no changes there. I also wanted to point at the high yield credit spreads as we do every week, okay? And although we got a breakout during the tariff tantrum and the big spill there, we've been talking about hopefully if we're going to be bullish and see new highs, seeing the high yield trade back below the breakout line and chop in a range so far seems to be heading that way. So this is at least one piece of data I can look at and say, okay, happy days so far, not looking too much like a set of financially stressed conditions just yet. This should be conducive to higher stock market prices so long as it can persist to chop in this range and come back below the breakout level. And then the last thing I want to point out before we get into the charts is the yield spreads, okay? When the yield curve inverts, everyone screams recession and they're wrong. When it reverts above zero, everyone screams recession and they're wrong because it is the acceleration to the upside that actually is synonymous with entering bear markets in the stocks. Armed with this knowledge, if we start to see this thing creep higher and higher and higher, it again would be an alarm to say that a top for the stock market could be extremely close. When we zoom in, no real sign of true acceleration yet. This is undeniably an uptrend, okay? But objectively speaking, we are still trading below levels not seen since April. So if we come back next week and we've got a massive green weekly candle, then I think we can start to be a little bit concerned. But the longer this thing trades in a range, sideways or down, the more conducive that should be to a much higher stock market. The other thing we like to do every week here is sharpen this thing to the 10-year 3-month yield spread. And if we look here, okay, this is exactly what we want to see. No alarm signals, continuing to chop in a range, actually officially as of this prior weekly close, have inverted again, okay? So this is very conducive to seeing new all-time highs in the stock market, as we've been saying every week. So happy days here, right? This is the first sign of improvement, perhaps actually the second if we use this right here as well. So if we can just get the 10-2 yield curve to follow suit, hopefully we can get the Fed to start cutting soon. Hopefully the 10-year yield can do the cutting for the Fed. Hopefully inflation is indeed going to be nothing more than a counter-trend wobble that ultimately resolves to the downside, and hopefully this labour market deterioration can start to improve. If all of those things are true, then we should be able to be at much higher stock market prices and hopefully avoid a recession. But of course the other scenario is that this data set continues to worsen week in, week out like it has been for a long time, that we do slowly but surely head into a recession, and thus any pump here to the upside in the stock market and in risk across the board will likely see a major top come in at some point this year. I do think we've got plenty of space with or without the recessionary data to run this thing into Q3 or even Q4. But if we just assume that the current rate of deterioration in this macro data set continues into the end of the year, then I think it is going to be practically impossible to officially avoid a recession. Time will tell as always. As always, this is just my base case. This is just my overall hypothesis and my framework from within which I make my trades. So far, we got the daily cycle low, we got the long on, we've got the risk managed, level 3 members notified in real time as always of the exact levels for entry and stop loss, and now it's just a case of waiting for the next daily cycle low to show up, adding to the position, moving the stops up, doubling the exposure without taking additional risk, and then we can use that upcoming daily cycle low, which I suspect looks something like this, to set an invalidation trend line off of, just like we did in all the prior instances that I showed you earlier on and that the long-time followers of the channel have seen me do in real time. So for now, there's not much to do, right? Long and strong, the market has revealed its direction. Happy days. Needless to say, at new all-time highs, okay, we have been able to invalidate the top call idea from back here where we went flat before Christmas. So the dip buying that we did in the spill does not have to be unwound here at lower high bounces. The trading position that we added here, as you can see, is also doing pretty well for now at least. So happy days, right? We can say, okay, bull market continuing. It clearly wants new highs. So who are we to argue with that? It's our job to just stay long and strong until it becomes unreasonable to do so. Like I said, we can easily and happily invalidate that top call idea now that we're at new all-time highs. And as ever, okay, the best way to be wrong is to make money whilst being wrong. I know a bunch of the level 3 members are chomping at the bit here because if you know, you know, right? We are slightly late for the daily cycle low, which means gold should be ready to bottom any day now. Once it does, with a fresh weekly cycle behind us, we should be getting ready to see some massive upside and overperformance here for the metals once more. And for Bitcoin, still long, still strong, still hunting some crypto-related stocks to add in the level 3 members section. There's nothing much to say, right? We've been covering this to death all week, so I'm sure you all know that there's a couple of scenarios here, and all we really need to do by now is allow this market to show us a few more candles, and after it's shown us a few more candles, we'll be able to start to scratch off one by one the possible scenarios that we've got going on until we're left with just one, which of course we can accept as the truth. So in summary, I think we can continue to stand with this base case hypothesis. I don't think anything is out of the ordinary, really. We continue to use the TA to let us know when to get out of the way of the markets, when to sidestep the drawdown and volatility, and when to be long and strong like we are now. As ever, I am not cheering on a recession. I am not trying to be a doomsayer here. I'm simply looking at the data and watching it slowly but surely deteriorate over time. At the same time as I am watching a Fed, which is, you can pick your fighter in this idea, right, is either incompetent, which I do not believe to be the case, or is deliberately late to cut, is deliberately organizing some kind of controlled demolition. But for now, at least, it doesn't seem like we need to worry about that. For now, at least, it seems like our job is to stay long and strong until we can find the next major or local top. And then we'll just do this whole thing all over again, just like we did in the prior times. For Bitcoin, of course, the focus, and for those crypto stocks, is really on getting to about Q3 of this year and then starting to at least take some profit off the table. But for now, at least, we're still early enough in the major 4-year cycle for Bitcoin to sit back and let this thing play out. As ever, we'll continue to take this thing one day at a time. We'll continue to be open to all possible outcomes, and we'll continue not to focus on being right or wrong, but rather staying on the right side of the trade. I'm your boy Camel. Have a fantastic weekend. Until next time, take care from me. All the best. Cheers. Bye.
Camel Finance, he's the man to see. Rocking the markets with his contrarian spree. Trades like a pro, no fear, no shame. Sticking to his guns in his money game.